Welcome to Money and Markets Series 3, Lesson 1. This is the beginning of a new ARC Series 1 built the arithmetic of money. Series 2 explored what happens when borrowers break their promises. Now, Series 3 is about buying and selling. And it starts with the most important instrument in fixed income, the bond. A bond is a promise. An issuer borrows money from investors, and in return, promises to pay fixed amounts on specific dates, coupons along the way, and the full principal at the end. But here is the question this lesson answers. What is that promise worth today? Not the face value printed on the bond. Not the sum of all the coupons. The actual price a rational investor would pay right now, knowing that every future payment needs to be adjusted for the time value of money. That adjustment is called discounting. And the price of a bond is the sum of all its discounted cash flows. Nothing more, nothing less. Let us start with the simplest case. One payment 1 year from now. Suppose someone promises to pay you $1,000 in exactly 1 year, and the market discount rate is 4%. What would you pay today for that promise? Not $1,000. Because $1,000 today could be invested at 4% and grow to $1,040 in a year. So the present value of that future $1,000 is 1,000 divided by 1.04. That gives you about $961.54. Now extend it. What if someone promises you $3,000 in 2 years at the same 4% rate? You divide 3,000 by 1.04 squared. 1.04 times 1.04 is 1.0816. 3,000 divided by 1.0816 is about $2,773.67. Each future payment shrinks when you pull it back to today. The further away it is, the more it shrinks. That is discounting. Now apply this to a real bond. Meet PQU, a bond with a face value of $1 million. It pays an annual coupon of 4.5%. That means $45,000 per year, every year, for 5 years. Plus the full $1 million back at the end of year 5. The market discount rate is 5%. To price this bond, you take each cash flow and discount it back to today. Year 1. 45,000 divided by 1.05. That is 42,857. Year 2. 45,000 divided by 1.05 squared. That is 40,816. Year 3. Same coupon divided by 1.05 cubed. 38,872. Year 4. 37,021. Year 5. This is the big one. 45,000 coupon plus 1 million principal, all divided by 1.05 to the 5th power. That is 818,784. Add them all up. The total present value of all 5 cash flows is $978,352.62. That is the fair price of the PQU bond. Notice something. The face value is $1 million, but the price is $978,000. The bond trades below par. Why? Because the coupon rate, 4.5%, is lower than the market discount rate, 5%. The bond pays less than what the market currently demands. So buyers will only pay less than face value to compensate. This is the most important relationship in bond pricing. When the coupon rate is below the market rate, the bond trades below par. Investors pay less. When the coupon rate is above the market rate, the bond trades above par. Investors pay more because the bond pays better than what is currently available. When the coupon rate exactly equals the market rate, the bond trades at par. The price equals the face value. This relationship is not a rule of thumb. It is arithmetic. Now watch what happens when the discount rate changes. Same PQU bond. Same 4.5% coupon. Same 5 years. But instead of discounting at 5%, suppose the market rate drops to 3%. Every future cash flow is now divided by a smaller number, which means every present value is larger. The price goes up. Now suppose the market rate rises to 7%. Every cash flow is divided by a bigger number. Every present value shrinks. The price drops. This is the rate price seesaw. When rates go up, bond prices go down. When rates go down, bond prices go up. Always, without exception. This seesaw is the reason bond investors watch central bank announcements so carefully. A rate hike means existing bonds lose value. A rate cut means they gain. If you hold to maturity, the seesaw does not affect your coupons or your principal return. But if you need to sell before maturity, the market price is what you get. And that price moves inversely with rates. Let us step back and see the structure clearly. A bond is a stream of cash flows. Coupons at regular intervals plus principal at the end. The price of that bond is the sum of the present values of each cash flow, each one discounted at the market rate. That is all bond pricing is. No magic. No black box. Just the time value of money applied to each payment one at a time. You learned present value in Series 1, Lesson 1. You learned discount factors in Lesson 4. Now you are applying the same tools to a real financial instrument. The only new idea is that a bond has multiple cash flows on different dates. So instead of one discount calculation, you do several and add them up. If you can do that for one bond, you can do it for any bond. A 2-year government note, a 10-year corporate bond, a 30-year mortgage-backed security. The principle is identical, only the numbers change. Why does this matter for you? Because bonds are the backbone of the financial system. Governments fund roads and schools by issuing bonds. Companies fund factories and research by issuing bonds. Banks hold bonds as capital reserves. When you hear that the 10-year Treasury yield moved, you are hearing about the discount rate the market applies to a 10-year stream of government cash flows. That rate ripples through everything. Mortgage rates, corporate borrowing costs, pension fund returns. If you understand how bond prices work, you understand why a central bank rate decision can move trillions of dollars of value in an afternoon. And the mechanism is exactly what you built in this lesson. A stream of promised cash flows, a discount rate, a present value sum. When the rate changes, the sum changes. And when the sum changes, wealth changes. Bond pricing is not an abstract exercise. It is the operating system of fixed income, and everything from here builds on it. A practical note on how bonds differ from the certificates of deposit you met in earlier lessons. Both are fixed income. Both pay a stated rate. Both return principal. But a bond is a tradable security with a market price that fluctuates. You can buy it today and sell it tomorrow. The price you get depends on where market rates have moved since you bought it. A CD is not typically traded. Its value stays stable because you hold it until maturity and the bank guarantees the principal. If you exit early, you pay a penalty, but you do not face a market price that has moved against you. That distinction matters when you are choosing between the two. A CD gives you certainty. You lock the rate, you hold to maturity, you get your money. A bond gives you flexibility. You can sell at any time, but the price you get is not guaranteed. It depends on the market, and the market depends on rates. Certainty versus flexibility. That is the trade-off. 3 ways to earn money from a bond. First, coupon income. The regular interest payments you receive while holding the bond. If you bought PQU, that is $45,000 per year for 5 years. Second, principal repayment. At maturity, the issuer returns the face value. If you hold to the end, You get your $1 million back regardless of what happened to market rates in between. Third, capital gain or loss. If you sell the bond before maturity at a price above what you paid, you earn a capital gain. If you sell below what you paid, you take a capital loss. Most individual investors focus on the first two. Buy the bond, collect the coupons, hold to maturity, get the principal back. But professional investors trade bonds constantly, seeking capital gains when they expect rates to fall, and hedging against capital losses when they expect rates to rise. Both approaches use the same pricing math. The difference is the time horizon and the risk appetite. 3 takeaways to carry forward. 1. A bond's price is the sum of the present values of all its future cash flows. Each coupon and the final principal discounted at the market rate. That is the definition. There is no shortcut around it. 2. When market rates rise, bond prices fall. When rates fall, prices rise. This is the rate-price seesaw, and it is arithmetic, not opinion. It drives trillions of dollars of value every day. 3. Bonds differ from CDs in one critical way. Bonds trade at market prices that fluctuate. CDs do not. Flexibility versus certainty. Both are tools. Neither is better in every situation. Next lesson, we ask a sharper question. If you see a bond trading at $950 with a 4% coupon and 4 years to maturity, what return are you actually getting? That number is called the yield to maturity. And solving for it requires algebra, not arithmetic. I will see you in lesson 2.